Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Mark Streeter. Mark is a Managing Director and the Head of Aviation Credit Research with JP Morgan. He's joining us for the purpose of our Aviation Leaders Report 2025, and we're recording this in New York in mid-October. Mark, thanks again for joining us. Always a pleasure to have you.
Great to be here.
Super. Before we get into the meat of the conversation, do you want to tell us a little bit about your role in JP Morgan?
So I work very closely with my equity research partner, Jamie Baker, and together we cover the North American airlines and the global lessors from a capital markets perspective. So we're very focused on all the capital that is being raised for the lessors, mostly unsecured debt in that regard. And then for the airlines, that can come in any form of EETCs, unsecured, route slots and gates, increasingly loyalty, all types of financing for the airlines. But we, of course, keep our eye on all the global airlines in terms of how they impact the lessors, and we work very closely with our global colleagues as well. I also cover the rest of transportation in addition to just aviation.
Excellent. And maybe we'll start on the airline side. Can you talk to us about your assessment of airline performance so far to date in 2024, and just whether you have concerns as we move into potentially more challenging macroeconomic or geopolitical environments?
It's interesting. The panel I just got off, we were discussing this a little bit because I think the perception is that it's not that good of a year for airlines. It's actually not a bad year if you look at the IATA forecast for global airline profits and if you look at North America specifically. But it's sort of a tale of have and have-nots because we've talked a lot about what we now deem the low-margin airlines. Used to be called the ultra-low-cost carriers, but now we like to identify them by their margin gap relative to the haves. As a little bit more specifically, Spirit, JetBlue, Frontier, they used to occupy the margin high ground. Now they basically are sitting at the margin low ground, and the industry spoils, and the pendulum has shifted towards Delta, United, American. And really what's driving it, Joe, especially in the US, but really globally as well, is the growing importance of loyalty. And a good way to sort of summarize it is that Frontier is a money-losing airline that has a very profitable aircraft trading business. Delta is a money-losing airline, but they have a very profitable loyalty business. And the difference between the two is the aircraft trading profits are very ephemeral. They can go away, and that's a merry-go-round that eventually will stop. The loyalty merry-go-round isn't going to stop. That's only going to grow and continue to grow in terms of performance as someone like Delta heads towards $10 billion of annual remuneration from American Express. If you're a low-cost carrier right now, you simply cannot compete with that, and you have to become more relevant. And that's why there is so much pressure to grow and on M&A. And obviously, mid-October here, by the time people are watching this, maybe we'll have better idea into what's going on with Spirit and what's happening with that restructuring in the US. But there's also lots of other global restructurings and attempts at M&A in order to bulk up, in order to become more profitable.
And presumably, taking that loyalty point, there's a significant barrier to trying to develop a loyalty program, right? So do you ever end up in a situation where the have-nots can become the haves, barring significant consolidation?
Well, if you just look at sort of the raw revenue that someone like Spirit gets from loyalty, right, it's less than $100 million. And again, you're comparing that this year to Delta, which is going to be north of $7 billion, heading towards $10 billion, right? So it's exponential in terms of magnitude, right? So, how does someone like a Spirit Airlines, generate that much more stable margin loyalty revenue, right? And the way you do that is you become more relevant. You really probably have to become bigger, but how can you become bigger if you're not growing profitably and so forth? Well, then you look to, and we'll see what happens in terms of any sort of in-court, out-of-court restructuring for Spirit, whether or not they re-engage with someone like Frontier, which we think is a high probability at some point in time, whether it happens right away or next year, whatever. But that was the whole impetus for what JetBlue was trying to do by merging with Spirit. It was just poorly timed in terms of the way the market evolved in the US at that end of the fare spectrum, where there was overcapacity and so forth. And of course, the judge blocked it, which turns out that good for JetBlue that it got blocked. They were going to walk away anyways. But it's so funny that the judge signed off on that agreement by saying, Spirit customers, this one's for you. And here we are, less than a year later, with Spirit on the step of some sort of formal, informal restructuring, because the business model just isn't working.
maybe if we move off airlines for a moment and onto the manufacturing side, and we had this conversation last year. Demand strong, supply constrained, and if anything, we're in a worse condition than we were 12 months ago. How do you think and we're sitting here, as you say, in mid-October, we've got the Boeing strike. Hopefully that's something temporary, right? But it's much broader than that. How impactful is the supply challenges on the wider aviation market?
So, listen, Gus Kelly has been very, forthcoming as the world's largest lessor and a public lessor about talking about how the runway of this tight trading market and aircraft market from a lessor's perspective is going to continue through the end of the decade. And he's not wrong, right? You might say he's talking his book and so forth, but if you think about Boeing this year was trying to get up to a high 30s rate per month on the MAX. They're going to struggle, right, to get there once the strike is settled and so forth, going into next year and so forth. And if you look at their forecast, the Boeing forecast, the Airbus forecast, long term, say what you want about short term and their bullishness and so forth, their long term forecasting accuracy is very strong. And both of those forecasts argue for a monthly production rate of single aisle aircraft approaching north of 70 units per month by the end of the decade. Right? And here we are with Boeing struggling this year before the strike, trying to get back to high 30s. They need to figure out a way to double production rate. And that's part of the long-term bullishness that people may have about Boeing, right? In terms of the stock price and the credit and so forth, right? But it is going to be a huge challenge for the industry, for the supply chain, right? To try to ramp up to where the long-term demand justifies. Because one thing that we've seen, Joe, time and time again, you've been around the industry for so many years, right? No matter what Mother Nature throws at the industry or the economy throws at the industry, the long-term trend on traffic is growing. The propensity to travel in China, in India, in Indonesia, Southeast Asia, et cetera, is going to continue to grow. And the need for airplanes is going to be there. And right now, we are in a very unique period in this industry where Boeing and Airbus cannot satisfy that long-term demand, and that their inability to produce at the level necessary for the long term, this will extend for years. And that is part of what Gus Kelly talks about when he talks about the value proposition for AerCap, whether he's talking about the stock or the bonds.
Yeah, and then going back to that haves and have-nots point, right? Are you in a situation where if you're trying to grow and develop, right, either as an airline or as a lessor, and we'll delve into the leasing groups in a moment, that this is where the supply piece bites, right? Because you could argue in a supply-constrained environment, maybe it puts some discipline on airlines, maybe it helps yield in the short term, but medium term, it's got to be bad, right?
Well, especially for those business models that were predicated on growth. Remember, the low-cost model, certainly in the U.S., was predicated on rapid growth, low pilot costs, low wage costs, right? Relatively low fuel and so forth, right? All of those are working against them. That's why the pendulum has shifted so much, right? And why we now call that subset sort of the low-margin airlines, right? Because what is generating margin, right, is load factor up front, the highest it's ever been, premium load factor, international, right, where yields are better than domestic and there's less competition, right? And loyalty. That is where you generate margin alpha, if you will, right? That is where the margin really comes from. So this has big implications, right, for not only M&A, but on the airline side, but also M&A on the leasing side, right? Because if you're a lessor, right, and you look at how sold out backlogs are now, if you're a lessor and you go to Boeing or Airbus and want to order airplanes, you're getting in line for deliveries in 2031, 32, 33. We've seen some of those orders right now with that sort of tail, right? So how do you, right, as a lessor grow if Boeing and Airbus aren't building enough airplanes, right? And that leads to more consolidation on the leasing side, which we're seeing.
Yeah, and maybe let's move on to the leasing piece, because we've got a population of investment-grade lessors who can tap, the deep pool that is the unsecured bond market, and then you've got everyone behind that piece, right? To build on your piece around consolidation and scale, it would imply that scale is just of increasing importance and barriers to entry in growing a leasing business are rising.
Well, if you look at aircraft leasing in general, right? An aircraft operating lease is a commodity product. Okay? And we can talk about how the Hazis of the world and the Kellys of the world and so forth and their platforms add incremental value in terms of what they can do. And it's true. I'm not denying that, right? But ultimately, when you break it down, right, aircraft leasing is a commodity business, right? And so you can add value at scale by being able to offer flexibility and other things that the smaller sort of commodity providers can't offer. But at the end of the day, what is going to differentiate you at scale is having a lower cost of capital, which is why it's so important that someone like AerCap has worked its way up the rating scale to high triple B, okay? And why you're seeing all that upwards migration in rating, right? If you just look in the last year, besides AerCap getting upgraded, we've seen upgrades at DAE, Aircastle, Macquarie, just to name a few, right? And there are other lessors that are high yield rated but are very focused on upgrades. Like Griffin is a great example, right? Azora just tapped the market, but they're telling an investment grade story. And on the flip side, you have entities like Castlelake. They created an entity, funded it with rated unsecured bonds and so forth. And they sort of showed up at the dance, if you will, to become investment grade and then realized that maybe this isn't for us. So now they're pivoting. They just sold that portfolio to Avalon, right? And Castlellake's still very much involved in the game, but they're going to be funding themselves differently. They're not going to play that same, call it the rat race, call it whatever you want, right? That race to scale and higher ratings and so forth. But for those that are involved, they better achieve lower cost of funding or their returns are going to lag, and that's going to put pressure on them to change the business model. And so we expect that to continue. We expect to see larger lessors. We expect to see lessors that are higher rated, and maybe even a smaller number of lessors that ultimately work their way up to stronger credit ratings. But the cost of funding should come down, because that's one thing we've been hammering home with investors now for 2 years. We talked about it last year as well, the theme of aircrafting over airlining. We actually like the aircraft business better than we like the airline business.
Well, one makes money, right? So I can understand why, right?
Correct.
Because to pick up a couple of themes on that, how do you improve? Like when you're talking to the rating agencies and you're selling your story, what are the key elements that are driving the upgrades?
Well, I think scale is one thing, right? And that's an important thing. That's something that Griffin's dealing with scale and seasoning and so forth. Macquarie had to deal with that. Macquarie, by doing the Alafco transaction, has allowed them to work its way up the rating scale. And so, part of it is just also some changing perceptions, right? Like Aircastle's been held back. They have very low leverage. They have these wonderful parents in Mizuho and Marubeni and so forth. But there was a perception with Aircastle that they have a midlife portfolio, and that's riskier. But is it really riskier right now, given what's going on the production side? And so, by the way, and that portfolio is getting a lot younger. So that's, for example, credit story that we've been very supportive of, because we think that risk has been mispriced. So there's going to be opportunities like that in the market for investors. But I think it's just going to result in, again, more pressure to move up that scale. And you do that by, obviously having a portfolio that resonates with the rating agencies and investors, a scale that resonates with them, and a balance sheet configuration which is focused on unsecured debt, right? Because when you're looking at an unsecured credit rating, you always want limited subordination, right? So you want a limited amount of secured debt. You want big unencumbered portfolios, and you really want to see these lessors that are dedicated to this investment grade track to focus on unsecured funding, build up those unencumbered asset pools, because that gives investors and the rating agencies the most comfort.
Yeah, and to pull another thread at that piece to get your thoughts around it, is the sector attracting more eyeballs from an investor perspective or an analyst perspective? And you've been around the sector for a long, long time. Are more people looking at it, and if so, why?
Well, the answer is emphatically yes, because opportunity drives interest and demand. So, for example, and we might have talked about this before a little bit too, but pre-COVID, in the high yield market, we used to think getting a deal done, $500 million deal, would be a lot. COVID happened. There was $20-30 billion of US dollar paper issued, and we blew through any preconception about how much could be done, because these were relatively well-structured deals, most of them. Route slots and gates backed, loyalty backed, et cetera. Billions of dollars for names like household names like Delta, United, American, Air Canada, et cetera, right? And the high yield market, which was always treating sort of the one-off unsecured airline bonds that were out there rated high yield, and let's be very frank here, right, that were often in restructurings because all the airline bankruptcies that happened in that period post 9/11, right, all the way through to the GFC, right? These high yield investors had a reason to re-engage. And they re-engaged in a way that it wasn't the most efficient right away, because some of these yields and coupons were wider than they should have been. But there's a lot of follow through because the airline performance actually followed through, and it ended up being a home run. Anyone who invested in the loyalty, the route slots, and gates deals that came post the initiation of COVID during that COVID rescue period, those are some of the best returns that were generated in the high yield market. So that has created goodwill now with that investor base who's very, very engaged, right? And we're seeing those deals priced much more efficiently. On the aircraft leasing side, which is predominantly an investment grade market, we now have close to $150 billion of US dollar capital market unsecured bonds that have been issued. So this industry, and many of your speakers on this video series will be on here talking about ABS, and ABS is coming back, and we're at $5 billion this year, and maybe we're going to get to $7.
I was waiting for you to bring up ABS.
Waiting for, we're going to get to $7 billion this year and so forth, right? Right now, and the same thing with EETCs, and I've been part of it because I like to feel I have a vested interest in having built up the EETC market. Just to give you some perspective right now, the entire EETC market is still basically less than $30 billion. It's basically where we were last year, even though we've had a couple of deals because of the amortization, okay? And the aircraft leasing market now is 5 times bigger. So investors call me, these new investors to the space that are trying to figure out what to do. Hey, Boeing and Airbus can't make airplanes. I want to invest. What should I be looking at? What I'm telling them is to look at that $150 billion pool of aircraft leasing securities that are out there, because they trade, there's opportunity, they're issuing, they're getting upgraded, right? That's what drives performance, right? ABS is fine, it's coming back. It's still a little niche market in the structured world, okay? And there's going to be opportunities there. EETCs are great when you can find them, right? But all of the capital markets activity, the vast majority of it is in the aircraft leasing space. And that's what we've built our research business around and focused on, because that's been where there's been some of the best opportunities. Yeah.
And then can you talk to me a little bit in your perspectives as we look at the interest rate environment and what's that going to mean for lessors, and in a similar fashion, how that's feeding into lease rates?
Right. Okay. So obviously, lower rates lead to lower cost of capital. That's a good thing, all else equal, especially in a sector that is ultimately a FinCo, right? Cost of capital, incredibly important. Now, with lowered lease rates, it's interesting, right? Because, and I was just literally talking to one of the leading appraisers before I walked into the room about this. What we're seeing right now, again, mid-October, right, is we're starting to hit a little bit of the ceiling in terms of lease rates, in terms of just what airlines can afford to pay, because of where their margins are right now. Because as we both referred to, it's not necessarily the most profitable business right now, even though this is a pretty good year for the industry in general, right? So there's a little bit of that. But in terms of asset values, there's still that upward pressure, right? Because there aren't a lot of new airplanes being built, and people are scrambling to buy airplanes and so forth. So it's interesting with lower interest rates how there's a little bit of a divergence right now between lease rate, which has that higher correlation to cost of debt and what airlines might be willing to pay for a lease rate on a monthly basis, and value. So it's going to be interesting to watch in 2025 if we see a little bit more weakness, or maybe just not as much strength in lease rate, but we see still very good values in terms of how portfolios are trading and so forth. Like, it just came out this week that the Castle Lake portfolio, it was disclosed with Avalon's parent, Bohai, that basically they paid about book for it, right? No one knew at the time because they didn't tell us, but now we know it was basically about book, which makes sense, right? And it sort of highlights the fact that, especially for, the platform trades and so forth, that they actually might be worth more than book, right? Which for a long time investors were very skeptical about. But if you just think about the supply-demand dynamic and so forth, it makes perfect sense.
Yeah, and that's probably feeding into the AerCap share price movement as well.
Correct. And if you look at, obviously, and there's been a nice flip-flop, right? Or a very interesting flip-flop between, where AerCap trade and Air Lease as sort of the two benchmark global lessors, right? AerCap, because of their ability to recycle assets, sell assets, and so forth, and book gains, especially because of the way they bought, whether it was, old ILFC or GCAS or whatever, you've seen a better appreciation by equity investors for the mousetrap that AerCap has. Now, Air Lease is catching up because they're starting to recycle capital more and book gains and so forth. So it's very interesting to watch not only the price book ratio for both, but also just the relative earnings multiples for both, because you get some good insights into how the market's viewing the cycle by looking at both of them.
Yeah, and maybe stepping back on the liability side and kind of parking the unsecured market for a second, your assessment on the health of the aviation debt market more generally, the conversations we're having this week seem to be it's pretty good. There's a lot of debt capacity out there with lots of different providers. Does that kind of reconcile with your view?
Well, let's just take a step back, okay? So the investment grade market right now, in US dollar terms again, which I know I'm very focused on the US markets, but we try to look at this globally as well. But US as a benchmark market right now, the credit index, I'm looking at my sheet here, it's 93 basis points, okay? We're very close to the all-time tights. In the 25 years that we've had sort of the modern credit indices, we've only been this tight on less than 50 trading days over that period of over 2 decades. So we are in the 1 percentile of tightness of credit spreads. We are not, however, in that 1 percentile in terms of overall yield. Because look at where the 10-year Treasury is today. And remember, we went through a long period of time when 10-year Treasury rates were, in the US at least, were below 1%, right? So now we're hundreds of basis points wider. So yields still, from a long-term perspective, look okay, but spreads are very tight. What that means, though, is that in the marketplace right now, the capital market spigot is wide open. Lessors have very good access to the market. There isn't that much differentiation in terms of credit spreads. If you look at, we just had an Azora debut deal, for example, which priced fine. I'm sure they thought it was too wide. If you look at where they priced relative to when Griffin, for example, first tapped the market, Griffin got better execution relative to where the high yield market was at the time, but still, from an all-in perspective, looking at their coupon and so forth, it was still relatively attractive capital for them. And you go up the investment grade rating scale, or up the rating scale into investment grade, and spreads are, even though they're a little wide for aviation, all in from that perspective, they're still relatively attractive for the issuers, for the airlines, the lessors, et cetera. The cost of debt is not holding anyone back right now. Okay, what's holding airlines back is where they sit on all those other factors we were talking about before, or for the lessors, what might be holding them back is just how are they growing? What is their path to growth, right? And what are their returns on their assets? But cost of debt right now is sort of, and that's my day job, is one of the least stressful things I'm worried about right now for the sector.
And I'll bring you back just briefly on it, and I know we touched on it before around ABS. And we've seen half a dozen transactions happen over the last couple of months, probably more in the pipe. I know you can be ABS skeptical, right? Do you think it is, or how important a tool do you think it is in aviation finance? Do you think we talk about it too much for its relative worth?
Well, on the conference circuit, yes. But it's not irrelevant from the perspective of, listen, and I think we spoke about this before as well, if we look at the aviation finance ecosystem and view it as a motor on a car, okay? Let's say it's a nice, V12 Jaguar or whatever, right? If the ABS market, if we don't have E-notes, okay, that's like your 12th cylinder to get that motor humming at maximum of efficiency. We've referred to before aircraft viscosity. Aircraft financing viscosity, and how viscous is the system, right? You need a fully functioning ABS market with E-notes to fire on all 12 cylinders, okay? But, I might say with the ABS market crippled, we might have only been firing on, 6 of those 12 cylinders or whatever. But we've seen the growth of private credit, for example, fill the gap from ABS, right? And that's something that's not unique to aviation. I think from an aviation perspective, people like to talk about all these private credit platforms and how they're new to our industry and so forth. But that's going on throughout all industries, right? So the role of private credit continues to grow. And what it's helped, and one reason why it's grown as much as it's grown in aviation finance is because the ABS market was on the sidelines. Right? So what's going to be really interesting is when the ABS market is back to fully functional and these private credit platforms, continue to grow and so forth, and then they're competing more head-to-head with each other and so forth. So, and that will be good for further trading opportunities. Now, trading is picking up a lot year over year from where we were, but trading is also constrained by the lack of Boeing and Airbus production and so forth, right? So you have all these confluent factors that are having an impact, obviously, on the market. But what I would say is that if we can get aircraft ABS back up and humming with this growth of private credit and so forth, this level of financing viscosity and so forth can get back to almost epic type levels, right? Given the amount of capital that's out there right now.
And shifting gears, Mark, it's something that I actually think we probably talked about more a couple of years ago, and people are almost tired of it, but I do want your perspectives, is climate change, ESG, with a particular focus on the environment and sustainability piece. Is it having a material impact on your ability to attract investors or the price of your debt?
So it's interesting. I'll say a couple things, and I coordinate credit for our group globally at JP Morgan. And one thing I'll say is that from an aviation perspective, so a couple things. Just on the tape this week, there's Southwest just reached an agreement with Valero for a SAF intake. But it's tiny. If you look at it as a fraction of the amount of jet fuel that they burn on a yearly basis, it's a rounding error, right? But it's window dressing, but it's necessary window dressing in terms of trying to move the ball in the direction that we know we all need to go. And SAF, although I still don't think it is the solution, it is something that can be done right now and it's worth pursuing and so forth. I think what's really worth pursuing, though, are new airplane programs, and also just getting Boeing and Airbus back up and running with the current generation of aircraft, which, don't forget, and I think the market has sort of almost forgotten this, that every MAX that's delivered replacing an NG, or every NEO that comes replacing a CEO, those airplanes are 15+%. As long as those engines can stay on wing, they're 15+ percentage points more fuel efficient, right? So we have this very interesting dynamic, Joe, right now, right, where we're seeing all these delayed retirements of planes that should be replaced by more fuel efficient planes, right? And so the path to decarbonization for the industry is to get old technology out, new technology in, and the new technology to replace the current new technology. And that's probably what's maybe most disappointing by what's going on with Boeing right now. And in terms of the problems at Airbus as well, is that it has seemingly pushed off the replacement aircraft programs, that's going to be the next real step change. That's what this industry needs, because there is no solving the problem of, without new, more efficient airplanes, with the fact that at 30, 35,000 feet, whether it's SAF or Dinosaur Jet K, it's still generating the same CO2. And in fact, some of the SAF has been shown to maybe be generating more problems in terms of contrails and so forth, which all needs to be studied and is all being worked out right now. So, ESG is still critically important, and the carbon footprint, and that's really what we're talking about, is the E side here. The S and G side affects all industries almost equally. Not equally, but all industries have some aspect of that they have to deal with. But really on the carbon front, this industry still has a problem, which is almost no matter what it does, its contribution to CO2 globally is going to continue to grow. And there's no denying that. And so I think the industry would be better served sometimes, rather than spending so much time on SAF, is really sort of addressing the root cause, which is aviation is, or the root problem here, which is aviation is critical to the economic growth and the advancement of economies, and that we need to come to grips with the fact that this industry's carbon footprint is going to continue to grow, and maybe that's not a problem, right? Maybe we should figure out ways that we can address it and minimize whatever that growth is, right, in a way that still supports the greater good, right, which is what needs to happen in these economies and quality of life and bringing up these communities and cultures and so forth, where, as is proven, aviation is fueling economic growth, right? So I just think there's sort of, it's not a day of reckoning, but it's a sort of taking a step back and understanding what the role of aviation is in the global economy and how that fits in with the carbon agenda.
Yeah. There's a couple of threads just to pull out there for a moment, right? So one, I agree with you on the narrative piece, right? So you get more proactive in the positive narrative, which makes a lot of sense. And then you got to go, well, who's the organ for that? Is that IATA? Who's the organ for actually pushing those benefits out? The other, I think, around SAF is just getting an understanding around the opportunity cost. If you're going to pump billions into producing SAF, that's an opportunity cost for a government that could spend it elsewhere, possibly in a more impactful way in CO2 reduction. But bringing it back then to my point, when you have an investor that picks up the phone to you and says, listen, I'm really get into some aviation unsecured bonds, who do you think I should go to? Are they asking you the makeup of their fleet and their carbon output?
So it's interesting. I mean, we've done some data. We've worked with IBA to show, for example, the carbon footprint of the EETC portfolios, right? And I did it just to say, here's what you can do right now with some of the technology out there that some of the appraisers have. And IBA has a carbon calculator, Ascend has one, or Cerium has one, and so forth. And I haven't had a single investor say to me, oh, I looked at your EETC carbon footprint analysis, and I've decided to sell this EETC because it doesn't fit my carbon agenda. We're not at that point yet, but I was trying to show investors, here's what we can do. And if you get that question, we can actually do this. And we've done the same thing with the lessor portfolios and the airline portfolios, right? Just from a pure fleet perspective, right? Here's the carbon footprint, and here's what that carbon footprint, we have the tools now, right, to say, based on the order book and planned retirements, here's how that carbon footprint will evolve over time. And we can make comparisons, lessor to lessor, airline to airline, right? And give investors that information so that they can fit that into whatever their carbon agenda is. Now, in the States, have I had any investors come to me and use this information and do anything with it actually? No, but we're getting questions. Now in Europe, obviously, ESG and the carbon agenda is much more still in focus. And so, and clearly on the banking side as well, and that's where it gets very real near term, right? Because all of the banks, including JP Morgan, but all of the aviation banks for the most part, right, they're under pressure from the regulators to reduce their carbon footprint for their lending portfolios and so forth. And they're putting in place targets and goals, right, for their customers to meet. That is going to have a near-term impact over the next decade, right, as banks are evolving how they're lending to the industry. So that's where I see the more near-term impact.
Yeah, no, I agree with most of that. Just in closing, Mark, and I always like to kind of close with this question, as you look out into 25, what are your optimism levels like? And maybe break that out between the leasing sector and the airline community.
Well, obviously we have an election in the US, and by the time people are watching this, we'll probably know what the political environment like here is in the US, but obviously just globally too, right? There's been some unrest with some of the elections recently. There's obviously a war still going on in the Middle East. Surprisingly, there hasn't been as much fuel price volatility as you might think, given a lot of the headlines coming out of the Middle East. So there's been a level of resiliency, if you will, to crude and to jet fuel that is somewhat surprising relative to maybe where it's been in the past. So we're going to watch all those factors very closely. And of course, Ken, in the US, the Fed orchestrate a soft landing, and globally other central banks are cutting rates and so forth. So when we're in a period of shifting central bank and monetary policy, that always leads to concern over economic unrest and so forth. But for now, all signs are looking fairly positive on 2025 in terms of it being equally, if not perhaps better than what we saw in 2024, which is strange to say given where the IATA profit forecast is relative to history and so forth. Can we actually have a better year in 25 versus 24? But I'm optimistic that we can.
Excellent. Well, listen, on that optimistic note, I'd like to thank you as always for your time and insights, and wish you and JP Morgan a very successful 2025.
Joe, thanks for having me. Appreciate it.